Good afternoon, everyone, and thank you so much for joining us for our webinar on the Prime London residential property market. Is now the right time to invest? My name is Emily Bernstein, and I'm a private banker in the City Professionals team at Investec. Well, I'm not actually Investec now. I'm at home because it's far easier to do a webinar at home than it is in a noisy open plan office. We specialise in helping senior legal professionals with their banking, lending, foreign exchange and wealth management requirements, with a particular focus on tailored mortgage solutions. Before I introduce you to our panel guests, it'd be great to understand what you're hoping to get from this session. I know that there are people attending who are interested for different reasons. Perhaps some of you are interested in your personal capacity, are looking to buy your first property, or perhaps looking to move. Or maybe there are those of you who are private client lawyers who will look after high net worth clients where property is a significant interest. Additionally, maybe there are some of you who advise banks on property transactions. If there's anyone else I haven't mentioned here, then please do maybe pop what you do in the chat function on the right. At Investec, we've been extremely busy recently with the high net worth market, with property being a key focus for many of our clients. And we're often asked from our clients what our views are on the UK property market, and in particular on the London residential property market. So today we're delighted to have partnered with Legal Business and to introduce you to two experts on Prime London residential property market. Firstly, I would like to introduce you to Hannah Aykroyd. Hannah is the Managing Director and founder of Aykroyd & Co., a boutique residential property advisory firm. Hannah works her magic, finding the perfect property in the perfect location in prime London for her time-poor, high net worth clients. Hannah, welcome. Thanks so much for your time today. It would be great if you could just tell us briefly a little bit about yourself, about Aykroyd & Co., and about who your clients are.
Thanks, Emily. So predominantly we are private client focused rather than for investors. And we mainly represent clients who are in finance, law, tech, and also entrepreneurs, with some high profile clients in the music industry as well. We tend to represent about 50-50 in terms of domestic based and internationally based clients. Although actually pre-pandemic, it was more like 70-30 weighted towards the international market. So it has changed a little bit.
Thanks so much. And secondly, I'd like to introduce you all to Marcus Dixon, who heads up the research and data analysis team at Lonres. Marcus, welcome. Please do tell us a little bit about Lonres, who you're providing data for and what they're using it for.
Thanks, Emily, and hello, everyone. I sort of look at the data and research for Lonres. So for those of you who don't know Lonres, we're a business-to-business platform for property professionals. And what that really means is that we have various subscribers who feed us up-to-date information about sales and lettings listings across central London. So we have the most up-to-date and detailed information on the central London property market, which means that we can give you information on what happened yesterday in the property market if we need to. Because our data is so detailed and up-to-date, we provide it to estate agency groups, banks, the Bank of England. We do a lot of advisory work for various clients. So, hopefully today I'm going to give you the sort of the numbers on what's going on, and Hannah can sort of add a little bit of the sort of coalface information. So between us, hopefully we'll be able to give you a good picture of what's going on.
And Marcus, you've locked Stan, your schnauzer outside, haven't you? He's not allowed in the call.
Yeah, so he's a bit of a Houdini though. So if you suddenly see a dog jumping up behind me, I might have to whip round. But yeah, hopefully we'll be dogless for this presentation.
And I don't think we have to worry about Hannah's banana plant, Bob the banana plant. I don't think he's going to cause it.
No, he's firmly outside. Yeah, doing quite well in the cold actually.
Thanks so much. So just to give you an overview, in today's session, we'll be discussing current market conditions and buying trends, as well as what the future holds for prime London residential property, where the opportunities currently lie, and we'll touch a bit on the buy-to-let market as well as rentals. A bit of housekeeping before I move on to the questions. This session is being recorded and all of you are hopefully on mute. If you have any questions, then please do type them into the chat function on the screen, and we will address them. We've left some time at the end of this session. So let's start with you, Marcus. It would be great if you can give us a flavour of what the London residential property market currently looks like, how it's reacted over the last 18 months, and the trends that you're currently seeing.
Thanks, Emily. Yeah, as a researcher, I've always got a few slides in my back pocket to show people. So what I thought I'd do is just run through a couple of slides for you, just to give a bit of a picture of what we're seeing in the market. Obviously, the UK market and the sort of outside of London market has been the one that's been attracting a lot of attention recently, with some pretty significant annual increases. I think I took a look at the latest land registry figures, which show the UK up 11.8% annually in terms of prices, with our data for prime central London showing an annual change of about 4.6 over the same period. So a bit of a differing performance, and there was quite a period where prime central London was always taking the headlines, seeing the highest growth. So I just wanted to sort of add a little bit of flavour around that. So I'm just going to try and share my screen, so hopefully you'll be able to see this, and I'll whiz you through a few slides, and then we can have a bit more of a chat. Hopefully you can all see my cover slide. So if you can't, then wave or frantically, and I'll try and do it. But I think we're working. So as I was saying, recently the sort of the national house price growth figures have been more impressive than they have for prime central London. But I thought it's probably a good idea to go back a little bit further than just the last 12 months, partly because it's been such a sort of an unprecedented period in so many ways. So I think it's interesting to look at what's happened to prices in different markets. In this case, I've gone back 15 years. So this takes us back before the financial crisis, so Q3 2006 up until Q3 2021. So the pink line is prime central London. So these are sort of your core postcodes, your Chelseas, your Knightsbridges, your Kensingtons, your Mayfairs. So your really expensive central London areas. The green, the orange rather, is London, so it's Greater London, and the brown one there is the UK. The prime central London data is ours at Longmose, and the rest is government data, so land registry, ONS. But what's interesting here is it just shows you how quickly the central London market rebounded following the financial crisis. So if you look at the peak, which was sort of in early 2008 in terms of prices, we saw that it took only about 18 months to 2 years for prime central London to get back to where it was pre-crisis. So we were talking sort of Q2 2010 by the time prices were back at where they had been before. For the UK, it took quite a lot longer, and we were looking at Q2 2014, so 4 years longer for it to get back to where it was pre-crisis. And so we saw, certainly from sort of 2009, late 2009 onwards, this real outperformance of prime central London, with the UK market lagging behind quite significantly. This all changed at the end of 2014, partly down to changes in the stamp duty rates. But we really saw prices drop in prime central London, but continue to increase, albeit quite slowly, across the rest of the UK. So, whilst what's going on at the moment makes it look like the UK is massively outperforming central London in the short term, actually, if you look over the longer term, the prime central London market has performed pretty well, but actually the lag that we've seen recently, whilst other markets have caught up, I think means that potentially there's some buying opportunities there. And I think we're probably going to come on and talk about that a little bit later. One of the really interesting trends that we've seen, certainly over the last sort of 12 to 18 months, is that the performance of areas of London has been different across all different neighbourhoods. So certain submarkets perform far better than others. And what's interesting is this can be, a matter of half a mile away from each other, a really different performance in terms of what's going on. So this chart here just looks at neighbourhood level, what's happened to achieved prices now versus the peak. So generally the peak was a quarter in 2014 or a quarter in early 2015, so around the time that those stamp duty rates changed. And as you can see, Knightsbridge and Belgravia prices on average around 23% down on where we were at peak. But other markets, Hampstead, for example, Kensington, Notting Hill, Holland Park, are actually now higher than they were at that 2014 peak. So some real sort of difference in terms of performance. And again, I think that's something that Hannah and I were going to talk about a bit later, but I just wanted to flag in terms of the numbers for what this means. So actually talking about even central London as a sort of as one area hides a lot of really sort of local trends in terms of what's happening on prices. Another sort of slightly odd trend that we've seen over the last year or so has been the differential in activity and performance at different price brackets. A lot of this is down to the stamp duty holiday, which obviously is now wound up. But when you're looking at figures in terms of what's happening with activity, it's been quite skewed this year, so you do have to be quite careful. So this chart here just looks at each quarter of the year, so Q1, Q2, Q3, 21, as well as the year to date, so January to October. And I've looked at the change in the number of sales compared with 2019. We've taken out 2020 for obvious reasons. But as you can see, those two stamp duty holiday deadlines, so the March one that never was, and the June deadline, meant that we saw activity across all price brackets increase pretty significantly in the first half of the year. And even more so in the under 2 million. So we saw an 88% increase in activity under 2 million compared with 2019 in Q2. A lot of the activity below 2 million arguably happened earlier in the year to meet those deadlines, so it's been a bit quieter since. But interesting that top end of the market, so 2 million plus, has continued to be busy. So that's a market at the moment that's a really interesting one, and where we're seeing a lot of activity, and the family house market in particular has been very busy. And so again, just one of the trends we've got to look at, the lower end of the market is a bit slow at the moment, but I don't think that's a sign that the market is slowing. I think it's a sign that activity was skewed earlier in the year. And lastly, I just thought it's worth flagging what's happening in the rental market for any sort of investor clients out there, or anyone who's looking to rent in the market at the moment. It's a pretty tricky market for tenants right now. The level of stock is significantly down on what we'd normally expect. So it's 72% down on where we were a year ago. I would say a year ago stock was relatively high. But if we look back at sort of 2019, we're still, I'd say, probably 40 to 50% down in terms of level of stock on the rental market, which has meant that rents have seen a dramatic drop last year, but a dramatic recovery this year. So this chart here, just the orange line, is probably the interesting one to look at. So it just sort of tracks what happened to rents compared with sort of pre-lockdown one, so in February 2020. And as you can see, they bottomed out in February this year at around sort of 17–18% down on where they were a year earlier. But now we're back to where we were pre-lockdown one. So we've got rents that are sort of 0.6% higher than we saw in February 2020. So a real rebound. And I think, again, we're going to talk a bit more about that a little bit later. But I'll just unshare my screen. I'm conscious of time, so I'll pass back to you, Emily.
Thanks a lot, Marcus. So Hannah, just looking at that, we can see that there are real disparities between what's happening in different pockets, different areas in London. What are you seeing currently? What are your thoughts on those sectors?
Yes, it's so easy, it's so interesting to see that data because it really ties in with everything we're seeing very much on the ground. Our clients are mainly focused on areas such as Notting Hill, Kensington, Holland Park, all the areas that you've probably been reading about in the papers. And obvious reasons though as well, it's people really want that lifestyle choice. It's being close to interesting amenities, having the buzz of a really lively village atmosphere around you. And of course, also the sort of wonderful leafy green areas that these sought after postcodes give you. The stock of sort of large family houses is also there. And that's what people are after. They're wanting sort of good size of family houses with large volumes, lots of light, and importantly, it is the access to outside space. So these areas are giving you, beautiful communal gardens, garden squares, and those are, they are all very sought after. And then conversely, it's sort of the areas which are actually pretty landlocked. So without access to those green spaces on your doorsteps, those are the ones that we're finding are struggling. And then, of course, it also is it's very much driven by the profile of buyer. So the domestic market has been very active during the pandemic, so the needs are very different. But obviously, they're going to be looking mainly at, say, large apartments with outside space or large houses within, say, quieter neighbourhoods. So that is the main focus.
And it was interesting looking at that chart that Marcus just showed, with obviously Knightsbridge with prices being down, was it 23% or so?
Yeah.
You could get your thoughts, or both of you, on where you think the opportunities currently lie. I mean, it sounds a bit strange, but value areas. I mean, I wouldn't ever have thought of Knightsbridge necessarily as a value area, but where do you think that what people should be looking that could be relatively good value at the moment?
Marcus, I'll let you.
Yeah, I mean, do you want me to go first? I mean, I think that I mean, for me, if it's like you're saying, Emily, it feels slightly odd talking about sort of great value in areas of central London where pounds per square foot are probably the highest of any of the areas that we're talking about on that list. But I think that at the moment, with as Hannah said, the buyer profile is more skewed towards domestic purchases, partly because travel corridors are yet to fully reopen. So we haven't seen the return of those overseas purchases in such significant numbers. So, I think there is an opportunity at the moment in those areas that have a high proportion of flats and that traditionally appeal to a high proportion of overseas buyers, like Knightsbridge and Belgravia, South Kensington, to a certain, to possibly Mayfair, Chelsea, Marylebone, areas where at the moment they are maybe not as sought after because everyone's attention is on sort of lovely leafy houses in St John's Wood, Hampstead, Notting Hill. Whilst everyone's looking sort of one way, possibly if you're looking for value, you look the other, and a flat in one of those locations could be a good investment because once those overseas buyers return, and I think we're all expecting them to do so, I would imagine that demand for those sort of properties will come back too. So it's for me, if you're looking for opportunity, it's Knightsbridge, which is a sort of a slightly odd thing to say, but
I do agree with that, and I would also add another areas which I'm a really strong advocate for, which is Earls Court. And I've been saying this for quite some time as well. I think it's one of the best value pockets of RBKC, Royal Borough of Kensington, Chelsea. It's got lots of garden squares, so you get that sort of leafy green space that everyone is so looking for. The transport links obviously are phenomenal there. You're still within zone 1, and you can easily jump out on the A4 heading west. So and of course, as most people will be aware of, You've also got the large Earls Court scheme, which has been on the radar for quite a while now, and it has had some setbacks. But with Delancey coming in a couple of years ago, you're starting to see slow, but there is a bit of movement there, and that's going to have a really long-term sort of positive, ripple effect for the area, which is really exciting. So. That's probably my top pick. And then I'm also going to add in Bayswater. And that's obviously been in the news quite a bit recently. But that's a really exciting pocket because you've got the Queensway regeneration, which is just huge. You've got 4 or 5 big landowners which effectively own the vast majority of Queensway. And so you've now, and they're all working collectively together to kind of create this sort of new improved high streets to try and rival Marylebone High Street or St John's Wood High Street, and it's really exciting. So you've got the Whiteley, which is a Finchatton scheme. Finchatton are behind 20 Grosvenor Square. They are a phenomenal developer. So they're leading the charge with Whiteley on the sort of north end of the Queensway, with the Six Senses Hotel as part of that. You've got Park Modern, another really fantastic scheme overlooking Hyde Park. And there's obviously a lot of development that's been happening just in the surrounding areas already. You can see that, and that's been happening over the last sort of 6-7 years. So of course, prices have already increased on the back of this, but I still feel that you are going to be able to benefit from some increase in pricing, because it's going to have to be at some point in line with its competing neighbour, Notting Hill, which of course everyone wants to live in. So yeah, that's my sort of second pick.
Thanks a lot, Hannah. Just coming back to you, obviously I'm thinking back to Marcus's slides and he mentioned that there's been an increased activity, all price brackets. What are you seeing in the kind of the super prime market, 10 million plus, compared with that below? Have you seen increased activity from there, Marcus, you as well?
Yeah, I think it's always important to sort of break it down between it's the price bracket. So yes, we're quite rightly talking that sort of north of 10 space. You can actually even break it down really into that super prime space as sort of 30 plus as well. But it's also the property type. So are we looking at sort of a period house versus a new build house, or are we looking at a period apartment or a new build flat? And they're all just very different. They attract a different type of buyer, they perform differently, and obviously the locations will have a huge effect as well. And then probably an important point to note as well is that our role as buying agents, we are laser focused really on best in class assets in whatever price bracket, so price brackets, and also location for our clients. So we have a slightly different view. It's not so much of a general view because we are always going for best in class. But I think the most important point here is the super prime market for family houses has been going great guns, and kind of going back to Kensington, Notting Hill, Holland Park, all these, St John's Wood, Hampstead, those have performed really well during the pandemic. There's been really sort of a flight for best in class, people wanting those sort of good quality assets. And they're prepared to pay for them as well. And what we've seen, we've been tracking houses sometimes that have been kicking around in the market for sort of 2 to 5 years, that have been either, say, overpriced, or they're subprime for whatever reason. Perhaps that's an inefficient layout, the location's not quite right, it's on the wrong end of a road, and they've been sort of sitting around for all this time. And then suddenly the pandemic's hit and these have been snapped up because perhaps they do have a large garden or whatever it happens to be, but also the stock levels have been so low throughout, which has been really frustrating for everyone. So the family house market's definitely performed very well. That new build sort of super prime market really has struggled quite considerably. But now that travel has obviously lifted, you've had those international buyers come in over the last couple of months, if not longer. We're definitely seeing those bigger buyers in town, and so there's definitely more movement there. But still, in terms of pricing, that's still quite soft in that market. The sub 10. Again, family house market, I think, has performed really well in these key areas, and sort of, again, the new build side has sort of softened a bit, but it's all coming back.
conscious of time and I've got lots of questions I want to ask. So I think I'm going to move on. Obviously, just with COVID hitting us, have you had people, Hannah, asking about specific they've got specific requests with COVID? What are they looking for? And also, the market, obviously, that you're working in, we're talking about, seems to be very buoyant. And I assume that there's a lot of people bidding for the same properties. So what would you advise individuals to do to just be prepared for when they do want to go out to, and purchase that property?
Yes, so I think with regards to buyers, you have to be so prepared at the moment. And even before the pandemic, I've always really sort of tried to nail this home to our clients as well. And really, when we start a search, we want them onboarded with a lawyer. And I have to say as well, it has to be a very good lawyer. We've got sort of a panel that we work with who are the very best in the market. And I don't deviate from them just because you need someone who is very commercial, who can sort of navigate sort of crunch points easily, who's just got that sort of experience. So you must be onboarded with a lawyer at the outset. And then also, clearly you need to have your financing in place. That is just so important. There's no point going out looking for a property if you don't quite know what your affordability is. And again, this may seem really basic, but it's just remembering that stamp duty is a huge cost. There are always going to be transactional costs with any purchase as well. It's just making sure that you run all the numbers and you're comfortable with what your budget really is, and you don't sort of overstretch yourself. But those are the two main things. When we offer for clients, we always copy in the lawyer and the private banker as well into any offer letter. And we know what the LTV is going to be, and it's a really kind of clear cut. And all of this, so buying and selling property is so emotionally driven so often. And it's just kind of trying to present yourself as a super focused, committed buyer, someone who's very steady, and you're giving confidence to both the vendor and the sales agent that you're going to be a reliable buyer, and you will perform, which is just so key. What we always advise our clients to do as well, which I think is quite a nice touch, is for them to write a personal letter to the vendor. Again, we will attach that to our offer letter, because I think creating that sort of emotional connection is so important. It's not all about the money. It's been someone's home for a very long time, and I think people sometimes forget that. As emotionally charged as they might be, the seller will be in a similar position.
Thanks so much, Hannah. Marcus, I know we were talking previously about rentals and obviously the change in the rental market. It'd just be good to understand a bit more about buy-to-lets, what you're seeing on the buy-to-let front. Is it still, are people still buying properties for investment purposes in prime central London? Obviously, we had the stamp duty relief come to an end recently. Has that had an impact on buy-to-let investments?
Yeah, I mean, I think that buy-to-let generally, not just in central London, is not necessarily as attractive an investment as it has been in the past. Albeit I'd say that central London has always been a relatively low yield investment. So people who are investing in property in central London aren't doing so generally for yield, they're doing so for capital growth. So actually it's been sort of slightly shielded from some of the the sort of buy-to-let taxation that's impacted on some other markets where people have been investing for pure return, and obviously the change in tax has really chipped away at that. So, but I think one of the reasons why we've seen rents sort of increase quite significantly over the past few months has been lack of stock, and part of that is because we generally tend to see sort of with buy-to-let investment and a new round of properties coming to the market every month or so from that new groups of investors who have been investing in London, whether they be domestic or overseas. And I think that we haven't seen as high levels of new of new sort of buy-to-let stock coming onto the market, which is impacting the amount of properties that are available, which is leading to increases in rent. So, I think that there is a situation where buy-to-let is less attractive, and possibly we're going to see more institutional investors or large-scale build-to-rent operators coming into London. Around the world, if you look into the US, institutional investment into the private rented sector is huge. And in London, it's still very much in its infancy. And possibly with what's going on at the moment, could see more people interested in coming in. The difficulty is that the sorts of properties that they tend to be interested in, they want to buy in bulk, they want to buy significant numbers of units. Generally, that doesn't suit the second-hand market, it suits the new build market. So I think that it's one of my questions, I suppose, for the rental market at the moment is, where's this stock coming from? Because actually there's been a bit of a slowdown in terms of new development, and this and people who are coming in to invest in large scale build to rent possibly will struggle to find developments. But I think there's certainly some opportunities, and this increase in rents will be good news for landlords who, this time last year, landlords were having a pretty awful time, and at the moment it's it's very much a landlord's rather than a tenant's market. But I think that in some ways they deserve a few months of increases, because it was pretty painful last year.
I'm just going to ask one more question, and then we'll go to the guest questions. Just obviously talking about investment opportunities in growth areas, what are your thoughts and predictions, Marcus and Hannah, on flats versus houses? Where do you see the growth area? Just your comments on that would be very, very helpful.
Yeah, I think from my perspective, again, so these key areas that I've mentioned a few times, I really feel that there will be continued growth there, although we're seeing some really high prices being achieved already. This may not mean too much to people, but there have been unmodernized houses in key roads in Notting Hill, for instance, going for sort of nearly 4,000 per square foot, unmodernized. These are really strong prices, and as you saw from Marcus's graph, we have exceeded the last peak in terms of pricing, which is really interesting. But I still think there's more to go. There are severe stock levels in these areas. I mean, sort of an anecdote for you. I'm aware of one family who are buying up houses, backing onto communal gardens for each of their children, and they have 4. They bought 2 already. These are the sort of circa 10 mark, and they're just holding them. They will be holding them for sort of 30, 40, 50 years, putting them in trust for each of the kids. And when you've got one family who are prepared to take out 4 properties out of the market, to be honest, it's quite frustrating. And that has such an impact on stock levels, but it also shows sort of how much faith they have in what is such a strong market. I think another area which we're seeing, which we feel is going to be quite strong, is the pied-à-terre market. That is going to see a lot more activity, and I think also the price is quite good value proposition at the moment as well, because the buy-to-let investors aren't there in the same way for these types of properties. But I think for those who have bought houses now out in the country, sort of reality has kicked in. They're going to be commuting in the winter back into London. I do feel that pied-à-terre market will come back as well.
Yeah, and I'd agree with you on that, Hannah. I think that the rental market is often an indicator of what could happen in the sales market in terms of trends, because obviously it reacts much quicker. And what we saw earlier this year was, as people generally started to sort of float back into the office, that the small, so studio 1 beds in central locations, so walkable into the office, were in really high demand. And I would expect that could mean that in a few months' time, or possibly when those people's tenancies come to an end, they've tried out the big house in the country, smaller place in town, and they could well be in the market to buy. So I completely agree. I think that pied-à-terre market will be a really interesting one to watch, certainly over the next 6 months.
Yeah, I think that's good. And actually, just one point as well, from sort of an investment perspective, when you're looking at a pied-à-terre, I'm certainly more pro going for a period property. I know this is quite a general comment, but I think a lot of people are being quite stung on high service charges in new build blocks. It is just something to be really aware of. It's very hard to control it. Whereas at least with a say a smaller period building, you can either sort of self-manage with your co-freeholders, or you can be a lot more into the detail on the costs involved in running that building.
Thanks a lot. So I'm just going to go to some questions here. I've got one question, and I know it's something that we often get asked in terms of what should individuals assess as, what should they look at, what should they offer when they're looking at the asking price? What should they assess, and how should they, what approach should they take when putting in an offer against the given asking price?
Oh, I know asking prices are slightly, how long is a piece of string? A key question I always ask is, who set the asking price? Was it the vendor or was it the agent? And it's a really neat way of finding out a bit more background. Is the vendor realistic, or are they being greedy? And I always really get people to sort of try and befriend every sales agent as well. I know they're working against you, but just try and very gently extract as much information from them as possible. What is the motivation for the sale? Any comparables that they might have. A lot of agents are quite sort of loose with information they probably shouldn't give, and that just all helps you to build a picture, and really on the back of that you can sort of pitch your offer correctly. There's obviously always a fine line though between trying to strike a sort of a really good deal to just quite genuinely offending someone. Which slightly goes back to my earlier point of just remember that if it is someone's home and it's not a developer you're buying from, they will be quite emotionally attached to that property. So it's just finding that balance. But I think a lot of it is just do your research, have a look online. I know it's very difficult for that sort of usual standard buyer to be finding out the sort of the right data. But just do as much comparable sort of analysis as you can, really, just to sort of help you pitch that offer.
We've got another question here. Do either of you have a particular view on 9 Elms as a place to invest?
I do, but I can let Marcus speak.
Yeah, I mean, I think that 9 Elms has been a really interesting one, and it's come in for a lot of flack, I think. Some of it deserved, some of it maybe not deserved. I think the opportunity with 9 Elms is that there are some fantastic occupiers of the commercial space in 9 Elms. So there's a real opportunity there in terms of good quality tenants. I think the difficulty with 9 Elms, and it's the growing pains that you get with any scheme like this. I mean, it's sort of similar if you look at Elephant and Castle, if you look at to a certain extent Canary Wharf, is that if you're in a market where you have lots and lots of pretty identical flats brought to the market at around the same time for around the same amount of money, on either the sales side or the letting side, it's much more driven by how keen other people in those developments are to let or sell the property. So 100 units come on in a block, all at £750 a week to rent. If someone suddenly drops their rent to £650 a week, then it sets a new benchmark for that scheme. So I think that there's an opportunity there. It's a young area. It's when it's done, it's potentially it's on the river. It's in a really good location. You look over to Chelsea. There's lots of if you look at it sort of and take the sort of reporting of 9 Elms away from it, there's a lot of upsides. But I think that be aware that buying into a big new build regen scheme has its risks, and one of them is a lot of almost identical properties. Another one that Hannah talked about earlier was the challenges of service charge. But yeah, I think that there's some opportunities there, but it's a very different investment from investing in a mansion block on the other side of the river, and you just need to be aware of that, I suppose.
Yeah, I agree. And I think just a couple of points really. I mean, and 9 Elms is obviously so vast, as Marcus has said. I mean, it really just stretches that whole way from Vauxhall all the way to Battersea Park. And there's a huge number of properties going in there, and you lose that rarity factor. And of course, they're not even anywhere near being all built either. But when you sort of look at, say, the Battersea Power Station in particular, I'm really excited about that part of the scheme. But that's obviously the flagship scheme. It's such an iconic building. That is going to be really, really exciting with some fantastic tenants, as Marcus has said. But I'm a little bit apprehensive of the entire 9 Elms scheme more generally. It's just that sort of lack of control over your sort of over the resale market kind of coming down due to lack of rarity factor. I would also sort of, Mansion Block over in Chelsea, or perhaps sort of Battersea Park, Prince Wales Drive. That's a really great area to be focusing in on. And I think, looking more from an investment perspective, if it was me, I would be buying overlooking Battersea Park, probably in a mansion block, or just one of the houses just south of that. So you're benefiting from having that new tube station in, which is obviously the end of the Northern Line, but you're not paying those sort of the slightly fuller prices.
Just one quick question before we wrap up. How do people find out what's available within the off-market property space?
With great difficulty. I think that's probably why I exist. But yes, good question. And actually, about 80% of the properties that we now buy are fully off market, and that has really increased. It was usually sitting at around sort of 60 to 70% pre-pandemic, so that's really increased. And I think particularly when you're in a seller's market, as a seller, why would you openly advertise your property, particularly when you've got, say, high value art, or just even from a privacy perspective? You don't want your neighbours to necessarily know that you're selling for whatever reason. Perhaps there's a divorce, or it's just a little bit sensitive. So actually taking that sort of quiet off market approach is really quite appealing for a number of individuals. And I suppose really having representation, you get obviously full access to absolutely everything in the market, whereas sort of trying to navigate blind, really, you're just going through to the portals. I mean, very little is on there. Anything sort of decent, sort of best in class properties, very few properties are on the portals.
Thank you so much, both of you. I know time has run out now. It was really, really informative. Thank you so much for your time. I hope everyone on here has found a little nugget of information which you can take away to have a think about. I know from my perspective, I look forward to speaking to my clients about some of the issues we've chatted about, including the value areas being Hannah, you mentioned Earls Court and Battersea, and Marcus Knightsbridge, as well as those investment opportunities, including the Pied de Terre. So thank you so much. If any of you want to get hold of any of us, I'm going to leave our contact details up right now. Hopefully my screen will allow me to share this. And then please do get in contact with us. We look forward to speaking to all of you soon. Thank you so much.